Welcome to Banking 101, a first principle jargon-free course on banking. In this lesson, we will learn about payment services banks offer to consumers and businesses. In the previous lessons, we learned that consumer banking products are sold to individuals and wholesale banking products are sold to businesses. They are grouped into cash management and credit products. Payments can be thought of as a horizontal product that cuts across both consumer and wholesale banking. In this lesson and next, we will do a deep dive on payments. 3 steps occur in payments and banks perform a critical function in each. First, the user initiates a payment. Banks provides instruments like checkbooks and debit cards by which this can be done. Second, the payment is authenticated. Banks provide methods by which the identity of the individual and sufficiency of funds can be validated. Finally, the value is transferred to the destination bank via payment rails. Banks allow access to these rails. We will learn more about payment rails later in this lesson. The instrument of initiation is the instrument by which the payer instructs her bank to initiate a payment. There are 3 types of instruments. First, cards like credit and debit cards. Second, paper-based forms like checks and money orders. Finally, payments can be initiated electronically without using cards, example via online banking. In the authentication step, 2 elements are verified. First, the identity of the payer. Second, whether the payer has sufficient funds. Let us dig deeper into each. Banks provide mechanisms by which payment initiators can prove their authority over the account from which value will be transferred. These mechanisms are of 3 types. First, is physical possession. Examples include when we swipe our card in a store or receive a one-time password on our cell phone. Second, is knowledge, like knowledge of passwords and PINs. Third is via characteristics that are inherent to us. For instance, when we open a banking app on our smartphone with facial recognition, many payments require 2-factor authentication. For instance, physical possession of a debit card and knowledge of PIN. Another aspect of authentication is verification of sufficient funds or credit limit. In case of cards, it happens at point of payment. This is not feasible for checks, but for prepaid paper like money order, the availability of funds is guaranteed. Electronic non-card payments can be push or pull. In push, the sufficiency of funds is tested when the payer initiates payment from her account. In pull payments, the beneficiary initiates a direct debit on our account. In pull payments, the availability of funds can only be verified post facto. So far, we learnt that the payer initiates a payment using instruments of instruction. The payer also authenticates her identity through proof of possession, knowledge or inherence. However, for this system to work, there must be some method by which the payer can communicate with her bank at the point of payment. Next, we will see how this occurs. The method by which the payer connects to the paying bank varies by the instrument through which the payment is initiated. Let us look each one in turn. When we use a card to pay, either in store or online, the request for authorization of the payment is transmitted from us to our bank through card networks like Visa and MasterCard. The same happens when we withdraw money from a third-party ATM. However, sometimes a bank issues a private label credit card in collaboration with a store. If we use the card in that store, no third party is required. No third party is required if money is withdrawn from an ATM owned by the account holder's bank. When we write a check and hand that check over to someone, there is no way for us to communicate with our bank electronically at that point. When we initiate a payment electronically from our bank's app, we are operating within the bank's systems. Hence, there is direct connectivity between payer and paying bank at the point of payment. Increasingly, we initiate electronic payments via third-party apps without using cards. How does the payer's request for a payment authorization get communicated to the paying bank in such cases? Banks increasingly offer APIs to which these third parties link to. This is called open banking. Some e-commerce websites also allow us to pay via our bank account. Once again, this requires the merchant to connect to our bank via APIs. Historically, if we wanted a third party to debit our bank account, we had to give them a one-time authorization for recurring direct debits. But APIs now enable us to authorize one-time payments. Once we have instructed our bank to pay and authenticated ourselves, how does money actually flow between banks? Consider Susan who wants to pay Tom. Their banks are not the same. But just as we can call a friend with a different phone service, money can flow between different banks. We will now delve deeper into payment rails, through which this exchange occurs. Imagine if instead of a payment, Susan was sending a package to Tom. The package could be transported to Tom via road, air, ship or rail. While Susan may not know which modes of transportation the courier company used, she feels the impact in terms of cost and delivery time. Payment rails are analogous to these transportation methods. While the starting and ending points are two bank accounts, the rails by which the transfer of value occur may be different. These rails are independent of whether Susan is making a payment as a consumer or in a business capacity. Payment rails are of four types: electronic non-card-based rails, paper-based rails, card-based rails, and crypto. We can conceptualize a payment as consisting of a source bank account, a destination bank account, and a payment rail that connects them. As you may know, in crypto the value is stored in a blockchain address instead of a bank account. For now, we will keep crypto payments outside our discussion. The source bank account may be owned by the payer, for instance, when using a debit card. Alternatively, the money may be held in a third-party bank account. Often, when we store funds in a digital wallet, those funds are held at commingled bank account owned by the digital wallet provider. Finally, the funds being transferred may be held in the account of a lender like a credit card issuing bank. The destination bank account could be a bank account held by the beneficiary. Alternatively, the beneficiary may receive funds in a third-party owned commingled bank account held by a wallet provider. The payment rails connect the two. To recap our discussion, banks perform three functions in payments. We will now take a deeper look at the third function of banks relating to payment rails. We will learn how these payment rails work and what role banks play in their functioning. The operational details of how payment rails work vary by country. However, the fundamental steps are the same, even though they may be implemented differently. In this lesson, we will focus on the fundamentals. We will begin our discussion with electronic non-card-based payment rails, which are of four types: wires, ACH, real-time payments, and correspondent banking for cross-border payments. We will begin with wires. Let us go back to the example of Susan making a payment to Tom. Susan banks with Bank A and Tom banks with Bank B. Both the banks are located in the same country. Next, we will track the steps by which the funds are transferred to Tom. The process begins with Susan initiating a wire request. She may do so by visiting the branch or via online banking. Once she authenticates herself, Bank A debits Susan's account. Bank A sends a message to the central bank with the details of Susan's payment. This message is in a structured format with fields that describe the beneficiary's bank account details. Both Bank A and Bank B maintain accounts with the central bank of the country. While citizens cannot maintain accounts directly with the central bank in most countries, banks do. The central bank debits Bank A's account and credits Bank B's account based on the message received from Bank A. The central bank forwards the original message from Bank A to Bank B. Since Bank B has received funds from Bank A at its central bank account, Bank B credits Tom's account. We will now move on from wires to ACH. Consider Mary, who is a payroll manager for a firm with 4 employees. She prepares a payroll spreadsheet, each row of which contains amounts to be paid and the destination bank account details of each employee. Mary's firm maintains a bank account with Bank A, but it so happens that all employees maintain their personal accounts with Bank B. Mary sends this spreadsheet to Bank A, so that the bank can debit her firm's bank account and send the funds to Bank B, who will credit the bank account of each employee listed. Earlier Mary used to email payroll files. But now, she can upload payroll files via her bank's portal. The total amount Bank A needs to transfer to Bank B is $7,000. Like Mary, Mark is also a payroll manager but for another company. Mark's firm maintains a bank account with Bank B, but coincidentally, the situation is inverse of Susan's firm. All of the employees at Mark's firm maintain their personal bank accounts with Bank A. Mark sends the payroll spreadsheet to Bank B. What would happen if these funds were transferred through wire transfer? Bank A will make 4 wire transfers, all totaling $7,000. Bank B will make 4 wire transfers, all totaling $5,000. There will be 8 wire transfers in total. Bank A will monitor its account at the central bank to confirm that it has received credit for each of the 4 wire transfers before crediting individual account holders. Bank B will do the same. If we reflect on what is happening, 8 employee bank accounts are getting credited. However, there is no reason the central bank should be transferring funds 8 times between Bank A and Bank B. It would be simply more efficient if only one funds transfer of $2,000 occurs from Bank A to Bank B at the central bank. Reducing 8 funds transfers to first of may not sound life-changing. But millions of payroll payments occur every payday among thousands of banks. The question then is, who will do the netting of Mary and Mark's payroll files? In an ACH system, Bank A and Bank B submit the files received from Susan and Mark to a network operator. The network operator calculates the net amounts and forwards to the central bank. It also forwards the files to the beneficiary banks who can credit the individual account holders. In the real world, there are hundreds of participating banks. Hence, it makes sense for a neutral third party with data processing capabilities to perform this step. The central bank then debits and credits the net amounts in the accounts that the banks hold with it. The name of the network in the United States is Automated Clearing House, abbreviated to ACH. There are two network operators in the United States for such payments: the Clearing House, which is a private company, and the central bank. Banks can choose to be a part of either. The transfer of funds between banks is done by the central bank in either case. This is a good time for us to get introduced to three terms that relate to stages by which ownership of financial assets are transferred. In the transfer process, both sides of exchange may be financial assets, for instance, when we are buying shares. Or only one side of the exchange may be a financial asset, example when we are paying cash for goods and services. The first stage is execution, when the intent to transfer ownership is finalized. In our ACH example, it was when the company submitted the payroll file to its bank. Settlement refers to the actual transfer of ownership. Continuing with our example, it is the point at which funds are transferred between banks and employees got paid. Clearing is a middle step that facilitates the settlement in some way. The network operator of the ACH payment rail is performing the clearing function. In the earlier example, the bank received a payroll file from its client. Each row in this file involved a credit to an account. But consider another example. The client of the bank is a cell phone provider who has direct debit authorizations from its customers. Every month it sends a file to its bank where each row of the file represents a debit from a destination account. Hence, ACH files can contain either debit or credit entries. The ACH process is broadly the same for both. You can now understand why a bank would give ACH initiation facilities to only entities it trusts. Otherwise, a business could use this mechanism to debit destination bank accounts where the account holder hasn't given an authorization. How does an ACH system actually works? We will look at this from the perspective of Bank A over a 3-day cycle. Not every ACH payment requires 3 days, but this is a baseline illustration. On day 1, through the day, Bank A continuously receives payment files from its corporate customers. Customers are given a cutoff time by which the bank must receive their files. At the end of day, Bank A consolidates all the individual files and submits to the ACH network operator. Some of the individual entries may be credits like payroll where the corporate is paying out. Some may be debits, where the corporate is debiting a destination account. The network operator would calculate the net amount each bank owes or is owed. End of day 1 represents settlement finality. This means that Bank A is on the hook to transfer funds to recipient bank from that point. On day 2, any of Bank A's customers can request recall of any payment they had initiated on day 1. At the end of day 2, the network operator submits the files to the central bank. On the morning of day 3, the central bank effects funds transfers between banks and the individual bank's credit or debit individual accounts. We can now review the milestones in the process. The first milestone is the business customer of Bank A submitting an ACH file. The second milestone is Bank A consolidating the payment requests of all its customers and submitting to the network operator. The third milestone is the network operator submitting the file to central bank. The fourth milestone is the transfer of funds between the accounts banks hold with the central bank. Finally, banks debit and credit their account holders. We can also observe the credit risk Bank A faces. At milestone 2, Bank A becomes liable to make payments to other banks, but it does not actually debit its customer's account till milestone 5. Hence, between milestones 2 and 5, the bank is exposed to the risk that the corporate customer will not have sufficient funds. If the customer has an upcoming scheduled obligation of $100 and the funds in their bank account is only $20, that means the bank is running a credit risk of $80. Most banks will assign an ACH credit limit to its customer, which is the maximum shortfall permitted between milestone 2 and 5. We can now see the 3-level structure of the ACH payment rail. There are the banks at the first level and the central bank at the top. Between the two is the network operator who is performing the clearing functions. We will now summarize the difference between wires and ACH. In wires, the funds transfer between banks occur on a near real-time basis. In ACH, the funds transfer is deferred. The reason is transactions are being batched together. In wires, the settlement between banks is on the gross amount. In ACH, the settlement is on net amounts. We have used the term wires and ACH because these are the names used in the US. However, the formal names for these payment rails are real-time gross settlement systems or RTGS and deferred net settlement systems or DNSS. In this lesson, we will continue to use the terms wires and ACH for convenience. Historically, RTGS systems were used for high-value, high-speed payments like paying the seller of a house on closing. ACH-type systems were used for smaller-value, lower-speed payments like payroll. But consider a group of friends who are paying for their share of a meal to the person who paid the restaurant via a peer-to-peer payment app that is linked to their bank accounts. This brings into picture a third type of payment rail called real-time payments, which is suited for lower-value payments but at real-time speeds. The RTP process begins with individuals or businesses instructing their bank to make a payment. The instruction may be delivered through an app or through a file upload, similar to ACH. Unlike in ACH systems, where banks bulk up transactions into batches, in RTP, banks immediately debit the payer and send the transactions received to the network operator. The network operator, in turn, sends the payment messages to the various beneficiary banks, who in turn credit the beneficiary. Milestones 1, 2 and 3 occur within minutes. But while the banks have debited and credited account holders, the funds transfer between banks hasn't occurred. Through the day, the network operator submits the net amounts to the central bank. In this illustration, this is happening once every 2 hours, but this varies by country. Finally, funds get transferred between the accounts that banks hold with the central bank. In real-time payments, the beneficiary's bank is exposed to the credit risk of the remitter's bank between milestones 3 and 5. This is because they have already credited their account holder, and if the other bank went bust prior to settlement, the beneficiary's bank is out of money. Going back to our example of Susan and Tom, now we can answer the question on how money transfers between banks when checks and cards are not involved. We can now compare the three systems. In wires and real-time payments, the account holders get credited real-time, while in ACH systems it is deferred. The settlement between banks is real-time in wires but deferred in both RTP and ACH systems. The difference is that in RTP, it is deferred by hours, and in ACH, by days. The amounts transferred between the banks are gross amounts in RTGS but net amounts in RTP and ACH. In RTGS, there are no limits on transaction amount as banks don't face credit risk from their customers or with each other. But in RTP and ACH, banks are exposed to credit risk. Hence, in these systems, network administrators impose limits on transaction amounts. Finally, the cost of payments is high for wires and low for the other systems. The main reason is that in wires, each payment is processed individually instead of being processed as part of a batch. While we reviewed the differences between the three payment rails, they all have two similarities. They all have a three-tier structure and incorporate two types of flow. All the payment rails follow a three-tier structure. The banks are at the base, the central bank is at the top, and the payment rail operator is sitting in the middle. In most RTGS systems, the central bank, itself, is the network operator. The role of the central bank in the payment rails is to effect settlement between banks. The network operators set rules that all participants must follow. In addition, they perform clearing functions like netting of amounts. The network operator can be a private entity or the central bank itself. Finally, banks, which are the focus of this course, provide account holders access to payment rails and are responsible for account holder level settlements. The next similarity across all payment rails is that there are two flows that occur. One is the flow of information and second is the flow of funds. Next, let us look at each one of them. The flow of information refers to data fields like the beneficiary bank account number, the beneficiary bank, etc. In ACH, the network operator specifies what the fields of the file should be. In wires and RTP, the information has to be structured as a message that must conform to specifications defined by the network operator. This page displays an example of a wire message in the US. We have already seen how the flow of funds occur. The central bank is responsible for transferring funds between banks, while the banks are responsible for crediting and debiting their account holders. But how does this occur when the sender and beneficiary are in different countries, and hence there is no one central bank? We are now ready to learn how cross-border payments occur. In our example, as earlier, Susan is paying Tom, but now Susan banks with Top Dollar Bank in New York and Tom banks with Poundwise Bank in London. Top Dollar Bank and Poundwise Bank have a correspondent banking relationship between them. This means that Top Dollar Bank maintains a GBP account at Poundwise Bank in UK. Poundwise Bank in turn maintains an USD account at Top Dollar Bank in US. These are called nostro accounts. Nostro accounts are simply bank accounts, but they are held by the banks. Going back to our example, Top Dollar Bank debits $1,000 from Susan's account and credits Poundwise Bank's Nostro account by $1,000 in the US. Poundwise Bank credits Tom £700 and debits Top Dollar Bank's Nostro account by £700 in the UK. Notice that money is not crossing the border. Rather, Poundwise Bank's holding of US dollars went up by $1,000 at its Nostro account in the US. On the other side, Top Dollar Bank's GBP holdings went down at its Nostro account in the UK. The exchange rate for this particular transaction is determined based on an agreed-upon framework between the two banks. In our example, Top Dollar Bank already had GBP in its UK Nostro account. You may be wondering, how did that Nostro account get funded in the first place? We will explain that shortly. The process by which Tom received funds from Susan requires Top Dollar Bank to inform Poundwise Bank that the latter needs to credit the British pound equivalent of $1,000 to Tom. This communication occurs via a SWIFT message. SWIFT is a messaging system. It is different than payment rails like wires and ACH because a payment rail involves both flow of information and funds. SWIFT only facilitates information flow. A correspondent bank is a bank in one country that provides services in that country to banks not operating in that country. Poundwise Bank is Top Dollar's correspondent bank in the UK. Top Dollar Bank is the respondent bank. Globally, there are thousands of banks. Unlike other payment rails, where banks are interacting with a network operator, in correspondent banking, the relationships are bilateral. It would be impossible for all banks to maintain correspondent relationships with everyone else. What would have happened if Susan's bank did not have a correspondent relationship with Tom's bank? An intermediary correspondent bank that has relationships with both will come into the picture. The chain of correspondent banks can be quite long. SWIFT messages flow across the banks with debits and credits of Nostro accounts across the chain. Consider Top Dollar Bank that maintains Nostro accounts in local currencies with different correspondent banks. In our earlier example, what if Poundwise discovered on receiving the SWIFT message there were insufficient funds in Top Dollar's Nostro account? To avoid such situations, Top Dollar Bank has to purchase foreign currency and keep all its Nostro accounts funded. How does that process work? Top Dollar Bank forecasts it will need £1 million in its Nostro account at Poundwise Bank. So, it enters into an electronic marketplace where FX is traded. A bank called London Bank is seeking to sell GBP and buy USD. They agree on an exchange rate and the trade is executed. But they have not delivered currency to each other yet. Now Top Dollar Bank and London Bank need to deliver currency to each other. In other words, they need to settle. However, they don't have a correspondent relationship with each other. So, London Bank wires GBP to Poundwise Bank using UK's RTGS system. Poundwise Bank credits Top Dollar Bank's Nostro account and send it a SWIFT message informing the same. What happens to the delivery of USD? Top Dollar Bank sends a wire in USD to Dollar Tree Bank, which happens to be London Bank's correspondent bank in US. Dollar Tree Bank in turn credits London Bank's Nostro account and sends it a SWIFT message. The funds held in this US Nostro account can be used by London Bank for any business purpose in future. Note that currency did not actually cross borders, but each bank's Nostro account held in a different country was replenished. There are two design principles behind correspondent banking. 1. Banks are willing to hold cash overseas in a different currency. Poundwise Bank transfers GBP to Tom from its own funds. In exchange, it is willing to hold equivalent foreign currency in the US. Second, unlike domestic payment rails, they are bilateral relationships individually negotiated between banks rather than multilateral hub and spoke systems. We can now summarize the difference between domestic and cross-border payments. In domestic payments, the banks maintain accounts with the central bank. So they don't have to maintain accounts with each other. The central bank simply debits and credits each bank. In cross-border payments, there is no central bank for the world. So, banks have to maintain bilateral Nostro accounts with each other. Even if the same bank has a branch in two countries, the branches will have to maintain Nostro accounts with each other. This is what makes cross-border payments less efficient. This brings us to three paradigms within payment rails. We have a multilateral hub and spoke paradigm for domestic payments and a bilateral paradigm for cross-border payments. When the euro was introduced in 1999, it made possible an ACH type of system across the eurozone. This was SEPA, the Single Euro Payment Area. A similar initiative in Africa is PAPS. Multilateral paradigms are being tried for cross-border payments, but correspondent banking is still dominant. You may be thinking that you often make cross-border payments without logging into your bank account. You may be using a third-party money transmitter or a credit card. However, these are instruments of payment initiation. Behind the scenes, the transfer of value occurs through correspondent banking. This brings us to the end of this lesson. In this lesson, we learnt that banks perform three functions in payments. First, they facilitate payment initiation through various card, paper, and electronic instruments. Second, they enable secure transfer of value through authentication mechanisms based on possession, knowledge, and inherence. Finally, banks provide payers access to payment rails. In this lesson, we covered electronic non-card-based payment rails. In the next lesson, we will cover the other payment rails. But before that, review the summing up section of this lesson.